Okay, so in this session, we're basically going to be looking at, some examples of how we would apply, the use of the Fibonacci retracement tool. It's not every single time that the use of the Fibonacci would be applicable. There are times when it's better to avoid using it. And how to best use it. I mean, we have looked at, Fibonacci a couple of times, but I want us to, see some more things about the Fibonacci even today. Okay, so I mean, this is the 4-hour time frame. If you are looking to use the Fibonacci, for instance, if it's not looking too good or too appropriate on one time frame, if you switch over to the next, you will find that it most likely would. So let's just go to various timeframes. For instance, I mean, obviously, if you are using the Fibonacci on the 4-hour, it is most likely the case that perhaps you are looking to swing trade as opposed to well, it could be day trade as well, but the higher time frames obviously would be the case that you're looking to swing trade. So, I mean, looking at this now, I mean, obviously we see that the price is here. That's where the price closed on Friday. But assuming, you are, well, if you do see this like this, the question is, will it be okay? Will it be effective if you pulled out the Fibonacci tool? Okay, that's on the 4-hour. Let's try the 1 hour, even as it is the case that we do tend to day trade. With when it comes to using Fibonacci tools, you do want to have clear structure, whereby you're not in a choppy market, as it were. A choppy market is basically when the price is just zigzagging, as it were. Perhaps even here, it's more or less just zigzagging. Well, perhaps not even so. Maybe zigzagging is not even the word for it, because this is more or less like just ranging. So some people would use it when it's ranging. I suppose if this is the 1 hour and it's ranging here, if you go to a lower time frame, it might not so much appear as a range. Let's just quickly try that out. We're basically just going to put that area in a box. Let's put this whole area in a box. Maybe this area. Okay. So I mean, if it's not going to be the best to trade it on a higher time frame, we go to a lower time frame. So this is the 1 hour. We are going to be switching to maybe the 15-minute time frame. I wouldn't. Well, I would say using Fibonacci is probably best on a slightly higher time frame than the 15. I suppose I would most of the time I would start on the 1 hour time frame as opposed to anything less. That does not mean that it wouldn't work on other time frames, that is the lower time frames. It just perhaps would be a bit not as effective. But we're going to try it out here now. The whole idea behind using Fibonacci is to find levels, different levels into which the price will retrace. I mean, if for instance, this is where we started, our Fibonacci, and we extended it all the way there, we can see it has retraced, somewhat to this bit before, going into this range or consolidation. Now, if we're starting it here, taking it all the way there, let's just do that. Say we did this, this is the starting point, and that's the ending point. It is usually because we believe the price is going to continue in the same direction. So if the starting point is at one level and you are drawing it up, you are assuming that the price is going to be continuing up, whereby this is just a retracement for it to continue up. But even as we see here now on this particular time frame, drawing it from here to there, it pulls back. Instead of just continuing all the way up, going above the previous high, it is instead gone into a range. Now, what's going to happen when the market opens and from this evening going forward into the new week, we don't quite know. I mean, yes, this is pound JPY. I believe pound JPY is going to be going up, for quite a bit. It so happened that, on here, which is the 1 hour time frame. Okay, so we basically see what's going on here. For some days, it has been in this range. Okay, I mean, that is a good thing in a sense, because when its price is ranging or consolidating for some time, when it does break out of that area, it moves in one direction or another in a powerful way. So what I want us to take away from this is that if we are using the Fibonacci retracement tool, it's because we think the price is going to be continuing in that direction. In this case, it's going to be continuing upward because this is where it started. If on the other hand, we had drawn the Fibonacci from the high, because in the previous example, we drew it from the low going up, which means if you retrace, it continues up. Whereas on the other hand, if we draw it from a high, it's because we believe the price is going to continue down after a retracement. So let's also do that example. So if, for instance, we drew it, I mean, in this case, we know the market has already played out, but, the first retracement, assuming when we saw it, all these bits had not happened, it was just this bit, then this is obviously how we would draw it, from the high to the low, that is where it began to pull back, retrace. And we see here it retraced up onto, it retraced by about 38.2%, which is a good enough retracement. I mean, we know when it comes to retracement, there is the 23.6. When price retraces to 23.6, obviously that is a shallow retracement. Traders usually want to start getting in the market when it gets to at least the 38.2, the 50.0, or most definitely the 61.8. So let's assume we saw it when it was pulling back. We will basically wait to see how far it will go before it continues down. And of course, on this occasion, having retraced, it definitely did pull, it did continue down. That obviously is what we expect, with, when we are using the Fibonacci retracement. Now, what if it was the case that when we saw it, this bit had happened, it was this one we were seeing? Okay, we still will start there. And just draw the fib to end here. We only really, would draw the Fibonacci, or we would only use the Fibonacci, as it were, when we see the price pulling back. And on this occasion, we see that it pulled back, but it did not even really get to the 23.6. Okay, well, I would suggest perhaps that is not what could have been done. Okay, let's try something else. What if by the time we saw this setup, the price was already here and it was beginning to pull back? Let's draw this. We see it pull back past 23.6. It did not quite get to 38.2. Now, why am I saying this? The reason I'm saying this is because, let's take this off. Well, let's move this away. Okay, let's take it off. The reason why I'm saying this is because you'll find that various people would use the Fibonacci tool in a whole number of different ways. I drew mine from here, the top, to here. When it began to pull up, when I saw it begin to pull up, I basically drew the fib from here to here to see how far it would go. And we see it went as far as 38.2. Now, what if when I saw it, it had actually, made that retracement and continued down, and it was now here pulling back up again? Where would I start drawing my fib? And by that, I mean, if, for instance, when I saw the chart, all these bits have not happened, but I came and opened my computer, my MT4, and I saw the price pulling back. I want to know how far it's going to go. So I would place the fib somewhere. I would start drawing it somewhere. Some people will start drawing it from here to here. Others, on the other hand, will basically draw it from here. They'll start it from here to here. And you might ask, why would they do that? Well, because they probably are thinking this, starting from this high, has become irrelevant, as it were. Since this was the recent high, they would want to start from here, to this point. And obviously, you can see if anybody did that, this would have pulled back to 23.6. It did not go higher than that. How about if we had gone the other way? It was pretty much the same thing, except that, on this occasion, it did not even get to the 23.6. Okay, so we are going to be looking at a couple of things, and obviously we would decide what is most likely the best way to approach this. Let's take that off. Okay, before we come back to explaining where I would suggest we start drawing it from, I want us to notice something. I'm sure we've seen it before. Okay, so basically, if we were to, when drawing the Fibonacci, you will notice that there is this red dotted line. Well, at least on my own, on mine here now, it's red, dotted line. I mean, you could obviously always change the color, but let's consider it this is basically what we call the Fibonacci trend line. The Fibonacci trend line. I mean, I'm sure we know, we do draw trend lines all the time. We draw trend lines all the time. And this is basically, similar to a trend line, which comes with the Fibonacci. Now, one thing to note when using the Fibonacci, if we're going to get accurate results, is that the price movement or the price action has to be close to the Fibonacci trend line. Even as we have it here, that's the trend line. I don't know if I'm sure it's, you know what, let me, let's see if we can change the color and make it look a bit different so that, let's make it a solid line. Okay, just in case it's still not showing properly. Maybe we'll try a deep sky blue. Okay, I think it's showing better now. So we see the Fibonacci trend line. So here we see that the price is not too far from the trend line. That is basically, a good way to know that, yes, we are drawing this properly, or we are using it and I'm most likely going to get, better results with it. What if we do it differently, like I said before? If we're to start from here to there, we can see the price is still, pretty close to the trend line. Still pretty close to the trend line. Let's look at examples when the price will be very far from the trend line. Because somebody could come and see this now and say to themselves, okay, fine. The price dropped, it's been consolidating, it's been, ranging here or consolidating here. Let me just, draw the trend line from the high there. Maybe this is basically where the price was when they saw it, or the price was here. Now, that would not so much be the best way to get, to use the trend line, to use the Fibonacci. You know why? Because you've basically omitted, or you've skipped all these previous lows, which could have been used. All these previous lows should not have been neglected. And you can see here that price is far away from the Fibonacci trend line. Now, guess what happened? I suppose it's not surprising that the price was dropping here. It pulled back up. You would have expected it to go all the way down, yes, like it did here, but continue further down. Because after all, that is why we use the Fibonacci. We basically want to know how far it will retrace before it begins to go lower in the same direction, obviously lower than the end point. So on this occasion, we started using the Fibonacci here. This was the starting point for the Fibonacci. This was the ending point. You would have expected the price to go lower and keep on going down. But no, it did not. I would say that is partly because it has been used wrongly. Whereas if you had placed it here, if you had placed it here, when the price retraced and it began to do this, you would know, like quickly that this price is most likely not going to continue down. That was the starting point. The ending point, the price retraced, yes, like you expected it to. It came here, it began to do that. It would have then occurred to you that, okay, I think this price would not be continuing down, at least, on this occasion. Maybe not just yet, maybe later on, but maybe not just yet. And after all this movement like this, guess what happened? It now went all the way to 61.8. Came back down. Well, yes, I suppose you could have still made some profit on this. It went to 61.8, where people would usually enter. Now, if somebody had drawn this and they still decide to enter and they were still watching this, they still decide to enter, well, yes, they would have made all this profit possibly. I mean, even if they came out here, they still would have made some profit, but at least you would not, have had the price go down much lower than, the recent low. Yes, it broke out here. This was a fake out, before it carried on up. The Fibonacci, as it were, is to give you, just like, the Elliott wave and, the harmonic patterns, they are to help you, with forecasting. They are to help you forecast where the market would most likely go. Not surprising that, when it comes to drawing harmonic patterns or Elliott wave, the Fibonacci tool, do come in very handy. The Fibonacci levels, play a major role when drawing harmonic patterns and the Elliott wave. So the Fibonacci obviously is something we need to begin to love more and, learn, seek to understand some more. So I want us to basically, consider some things tonight. So one thing we've learned, at least tonight, is that the starting point of the Fibonacci and the ending point should be such that the prices are more or less, tugging or close to the Fibonacci trend line. That would give us an earlier idea as to whether the price is going to continue in a certain direction. As you would have expected, when the price pulled back like this, you would have felt, okay, fine, it's because it's most likely going to continue. But on this occasion, it did not, and because it began to do this, you would know. Okay, so I want us to look at some more examples. We did talk about this box earlier on, the price action in this box. And we did say that if on one time frame, it is in a range or consolidating, when we go to a lower time frame, we might be able to actually get a trade. Now, this is the 1 hour. Let's drop to the 5 and see what happens. Well, I suppose you would not necessarily want to be trading this. Now, I know it's a huge, let's go back to the 1 hour. I know that the range of the box is high, is much. I mean, it's a range of over 120 pips. Yes, somebody might say, well, 120 pips, even if it's 20, 30 pips, I get out of that, that'll be fine. Okay, let's see what would have happened. If we go to, let's go to a lower time frame. Let's go to 15. I mean, obviously, when we are, as forex traders, we don't necessarily want to be forcing the trade. We don't necessarily want to force trades. I mean, looking at this now, yes, we've come to a lower time. Let's go to the 5. Go back to the 15. Now, I mean, looking at this, for instance, ideally what you would have thought or wanted is for the price having, come all the way from here, from down here, all the way up, retraced, is for it to carry on up. We see it's more or less the same thing that, we find on the 15 that we also see on the 1 hour, whereby the price basically, went in one direction, retraced, but did not continue up. This is the 15. On the 1 hour, well, it's pretty much the same thing, because this is where we would have started if we're drawing the Fibonacci, here. We would have started with this, we would have started at the low here, ended here, got the retracement, but then it did not pull, it did not continue up. Like I say, it might continue up this week. We don't know. We'll just wait and see. Now, if we go back to the 15, someone might say, okay, well, I think I definitely can get some pips out of this. So where would you start? Let's say you started from here. Let's say by the time you saw this chart, by the time you saw this chart, the price was moving up like that, fine. And then it began to pull back, and you brought out the Fibonacci tool and began to draw from the low to the high. I mean, I'm basically, forcing it here, I'm pushing it here, because obviously seeing the whole of this, I would not so much even think of trading it, at least not using Fibonacci. I might look for a different strategy, but it won't be necessarily using the Fibonacci. But fine, we want to push it nevertheless. Start drawing it here to there. It pulls back to where? It pulls back to this line, which is 23.6%. Okay, this was the first time it touched it. We were expecting it to continue up. What happened? It basically went, as high as where we stopped. I mean, obviously, you would have had to find some price action, that would take you in. So the price pulled back to, retraced to 23.6. Where would you have entered? How would you have entered? I mean, the thing is, you almost do not have, it will be difficult getting, an entry on this one. The price had been dropping. This was the first bullish candle. Where would you have entered? Would you have entered here? I mean, honestly, I would not necessarily have entered there. I mean, would it have been the next candle, which was very small candle, like an indecision candle, really? And then the next one had a weaker top showing a rejection. So you see, it would have been difficult to enter with this kind of price action setup. That is obviously why I would suggest that if you are going to use the Fibonacci, we definitely start using it on the 1 hour time frame, so that we will have enough candles and price action, setup to be able to get in. So fine, if you want to push it, you decide to get in here. You pull back. When it began to go back up, you assumed, okay, the price is definitely going to continue higher than that high. But no, it didn't. It began to bounce, back and forth within that range. Well, yes, it pushed up at this point, assuming you got in here, would you have stayed in waiting all this time in the trade? It went so far, 23 pips. That would have more or less been the whole day. Let's see. You got in here. This is one day. The next day, so it took about 24 hours or so, almost 24 hours thereabout, to get 33 pips. And guess what? It began to move down very sharply, like a falling knife. So you see, I personally don't like trades that I have to necessarily micromanage, or trades that would not make me have peace of mind. There has to be a wide enough range for the price to move. If I'm getting in the trade, it will be the case that I believe that from one zone to the next that I am targeting, if I am obviously, if you are like when we're trading, we are trading, using the swing lows and the swing highs for our stop loss and take profit. It has to be the case that I have, enough range for the price to move for me to collect enough pips, and I'm out of the trade. I do hope, all kinds of thoughts are basically, coming to your mind, even as we look at all this. I mean, it's just for us to know or begin to have an idea of what to do and what not to do, or how to do things and how not to trade, in such a way that you basically just do not have peace of mind. So I would rather trade, take trades using the Fibonacci on the 1 hour. Now, I want us to also notice something here, just in case you've not quite noticed it. Let's take this off. Okay. When we join the Fibonacci, for instance, let's draw this one. Let's draw it from here. Okay, from here to here. From here to here. Notice that on this occasion, this is the starting point, and that's the ending point. We drew it from here to here. The starting point would always be 100. I know you might not be able to see this because it's stuck within, it's stuck on top of the price there. So let's do this. Let's do it this way. Okay, so we started drawing it from here and stopped there. The starting point is always 0. So what we're expecting here is that the price will retrace and it will carry on above 0. Sorry, did I say 0? The starting point is always 100 and the ending point is 0. So when we are using the Fibonacci, we're expecting that the price would start here to 0 and it will pull back before going above 0. So any price here now, the price above 0 on this occasion is the negative, or are the negative Fibonacci levels. Sorry guys, just 1 minute. Okay, sorry about that, guys. Sorry about that. Okay, so basically, I want us to notice that when we start at a certain point, drawing the Fibonacci, we start at 100 and end at 0. So what we are hoping, or what we are believing would happen, is that the price, having retraced, would now go above 0. Now, this is, a bullish move, obviously. We are expecting a bullish move. So it goes above 0 there, and the numbers above 0 are negative Fibonacci levels. Whereas the numbers below here are positive. Okay, I know this is perhaps, we need to get our head around this. So I will take my time and explain this. I obviously just posted, some Fibonacci levels on the Telegram group. Let's just quickly go there. Okay, so we can see here, these are obviously the levels. Let's start from the top. I posted 6 of them there. Let's start from this one. We can see here, these are the regular, well, perhaps I could call it regular levels that we are used to, 23.6, 38.2, 50.0, and all that. These are not negative. It continues here, 50.0, 61.8, and all that. So this is what we are used to. The ones we are used to, fall within 0 and 100%. But I'm sure, like we've seen lately, we do have the others that are the negative, and the, negative Fibonacci and the positive Fibonacci. Negative, meaning, they are minuses, they are below 0. And the positive one are above 100. Like we see here now, this one is obviously, this is a number bigger than 100%. This is 161.8, 261.8. What we should do really to make it easier, perhaps, easier to understand, is to make some of them negative. We'll make some of them negative. So we can see these ones now, the regular ones from 0 to 100, they are positive. If we do this, we see these are the bigger numbers, these are greater than 100. These are positive. But the ones on the other side of 0 are negative, obviously, like we learned in maths. Let's make this stand out, okay? So what we're going to do, we want to basically have this one with minus, next to them, so that it's immediately obvious to us when we see it that it is, or they are negative. You don't have to do that, but let's just, try and do that now. We know the way we added it to, well, I suppose we can remember how we added the numbers the other day, but we're just gonna, have a look now. You would right-click on there, go to Fibo properties. Okay, and choose Fibo levels. So you would basically, if you scroll down like this, you will see that some of them are negative. The description here, we see the levels. This column is for levels. This is for description. the description obviously is what shows here. So let's try some of this. We see here, some of the levels are negative, like this one. Okay, let's be consistent. Let's make it 0.0. You know, we want sorry about that, excuse me. So let's be consistent. We want it to be in decimals. Okay, okay. Okay, there we go. So what we're going to consider now is the ones that are negative, like this one. Minus 1.0 is the 200 is the description, which is the 200 here. So this is actually the negative one. And this one obviously is the negative one as well, minus 161.8. So we see 161.8, 200, 244, they are on the other side of 0, so they are negative, even though it doesn't show negative here. The ones on this side are positive. They don't have to, you know, have the positive sign. That's what we learned in math. You know, when it doesn't have it like that, it doesn't have plus or minus, you know, we know it's plus. But let's add the minus to this one. Let's start with the 161.8. It has a minus there. Let's just do that. Let's add a minus. Let's click OK and see if it changes here. Okay, so we can see it has changed. It is now minus. Let's add minuses to the others as well. So we definitely know that they are the negative. You know, what we are also going to do here, you know, because like we did, we drew from the low to the high, okay, from the low to the high. We are also going to reverse it where we will draw from the high to the low. So what is the negative numbers here at the top now will now switch places and be on the other side. I want us to get our head around this. I know it could be a bit of a tricky one, you know, if you are, you know, following this for the first time. Okay, let's make this ones negative. We want it to stand out visually. That's basically why we're adding it. We don't have to. I mean, if you are used to using the Fibonacci, you'll be able to tell which one is negative and which is not. So minus there. We're going to add minus to the 224 as well. Okay, add minus to the 224. Minus there. Okay, 224. Okay. So we can see, you know, they all have minuses there now because they are on the other side of 0. You know, think of it this way. Think of it this way. Think of it this way. Okay, so I want us to, I'm basically doing this because I want us to, I don't want the numbers on that. You know what, let's move away from here. Let's go to a place where, okay, we don't want the numbers on the candles. Let's draw it like so. Okay. Right, that's better. I think. Yep, that's better. So think of it this way. We have what we are used to when it comes to Fibonacci levels from 0 to 100. If the levels continue down this way, obviously, the numbers are going to be increasing from 100. You know, if we had 120 there, 130, they will be there. Obviously, it's increasing. You know, then obviously we have the 1.6, 1.8, and so on and so forth. So these are all increasing. They're all increasing. They are pluses. They are positive. But when it's the other side of 0, it is definitely, you know, decreasing, as in minuses. Now, like I said, this was a bullish move we're expecting here. That's why we drew it from the bottom, from the low to the high. So the minuses are on the top, at the top. We are now going to do it the other way around, whereby we are drawing it from the high to the low. And we can see here that the minuses are on the other side. Okay, I suppose having done this now, I'm going to have to take a screenshot, fresh screenshot, and post in the Telegram group for us to copy, you know, to add, or so that we can have the minuses there. I know those of us here tonight would understand it, but those who are not here might not quite get it. So this is basically, you know, some things we need to know about the use of Fibonacci. I thought we would, you know, apply or, you know, apply Fibonacci some more before we actually now go back to seeking to draw them or to use it when drawing the harmonic patterns. Because obviously, you know, we started doing the harmonic patterns and it was a bit of a tricky one. It was a bit too complex or advanced for some people. So I thought, fine, let's spend more time on the Fibonacci and perhaps delve deeper into how to use it and some other nitty-gritty about Fibonacci. You know, that would help us begin to understand, you know, some more complex things that are to come. Okay, so this is basically, you know, a harmonic pattern that, you know, we, you know, drew out maybe I would say some weeks ago, and we see what happened here. You know, this obviously is the X, A, B, C, D, and D obviously is always the, you know, the entry point, the price reversal zone. You know, what we would obviously do is at that point, you know, where we find the D, we will think of the nearest, you know, the previous structure and seek to use that, you know, for determining where to place our stop loss. I mean, from here now, if we look left, I mean, that's the previous low. I mean, that would be too tight a stop loss, about 18 pips. So from this swing low, we will consider other swings. I mean, if we look further left, we can see there's one here. We just need to look past the candles, you know, on the left, and we can see one here. So we could decide, okay, fine, we will have that there, which is basically what I have here. So from here to here, you know, would be, the whole of this area will be like the price reversal zone. You know, you are still wanting to get in somewhere here, but preferably even, okay, let's do this. I mean, preferably if it goes below the D, yes, even though you might still want to get in somewhere here, if you get the right price action, I would say, you know, it would be better to wait for it to come back above D, you know, before getting in. Now, with this one, depending on how you entered, if you entered, it would have come back to hit your, it would have hit your stop loss. It would have taken you out, you know, the trade, out of the trade. But how would we have traded it? having lost that trade. The thing is, we must, note that when the price or the direction, switches, it's still a very tradable trade. The market presents us with another another opportunity, sometimes in the same direction, or it could be in the opposite direction. But on this occasion, it was another opportunity in the same direction. So we see what happened here. I mean, this trend line would not have been there, at this point. If the price came and hit stop loss and started going back up, you wouldn't have had that trend line. It's only when it now pulled back, you kind of like realize, okay, fine, I can draw a trend line there. And you draw that as the trend line, using it as a guide. So what you would now want is a break of that trend line, or perhaps you might even want to trade a bounce off the trend line. But because of the setup, I would most likely prefer to trade the trend line, because see what happened. After it broke the trend line, it went past C, which is obviously one of the targets we would usually have. It almost got to A. Well, I suppose you could argue it got to A. So basically, it played out well after all. The market makers, if you want to call them that, they would always want to move the price in a different direction to hit our stop loss. It's almost as though they are wanting to see how resolved you are, to trade your pattern or to trade your strategy. How would we have traded this? I mean, being that we are using the Fibonacci, tonight, or we're having a look at the Fibonacci tonight. Now, when price breaks above this trend line, let's delete all this. When price breaks above the trend line, you would mark the point at which it broke the trend line. Obviously, it came up, it went there, came back, went there again, eventually broke it here. So you place the horizontal line there. And then obviously you could decide to pull out your Fibonacci tool. You are not going to necessarily, be looking to measure from here. You could decide to start drawing from here. But let's say let's assume, you start from here. We'll do the two scenarios, like that's basically what we've been looking at so far. From here to the high that it got to, it pulled back to the golden zone. Well, it pulled back into our golden zone between 50 and 61.8. And when it pushed back up, I suppose you could have entered there. I would not have done it that way, to be honest with you, because we know when we have a trend line, it tells us a story. It gives us a clue as to which way the price is going. We will want to wait really for price to break above or below the trend line, depending on whether it's a bearish trend line or a bullish trend line, before we actually then jump in. So I would not have been looking to use the Fibonacci, from here, starting from here to there, because this is basically still the inside the trend line. It's on the other side, on the inside of the trend line. I'll be looking instead to stop at a point where the price had broken above the trend line. So I will use my Fib this way, not starting from here, because it went there, pulled back. The point of the next impulse, because where it started here is the impulse move. So we have the impulse, the correction, and the continuation. So we always want to start drawing the Fibonacci tool, retracement, from an impulse. This was an impulse. that is the next impulse. So we'll start here to there, and we'll see how far it pulled back. I mean, on this occasion, look at this. On this occasion, it pulled right back into the right back below the trend line. If you like, it was 100% retracement. So I would not necessarily have, entered here. I mean, would you have wanted to enter here? Because some people will be looking to get in here at the 50, or because that's where it first broke out. We want to be very patient. After all, some of us have a whole number of charts open with different pairs. If the setup is not right on one pair, move to the next pair and have an eye on this pair you are watching, because you've seen something that could possibly go your way, a trade setup that is, developing. Let's take this off as well to make it less messy. So you could start here, and because it pulled back 100%, that usually is not, that should be, a red flag for you as to, oh, I don't know if this is now going to continue down. After all, we saw the harmonic pattern, which says it's going to go up, but who says the harmonic patterns don't fail? They do fail. They can carry on down. What I would do is to basically wait for the price to give me a definitive clue as to where it really wants to go. It came back all the way. I began to go up again. And when it's pulling back, because we know that's when we pull out the Fibonacci, isn't it? When there's an impulse move and the correction is in place, that's when we pull the Fibonacci out. If we're starting here as an impulse, it's only when it begins to retrace that we will use the Fibonacci. So when it came back 100% and it went back above the line again and began to retrace, we'll pull out the Fib again. If the market wants to play games, well, we will be patient until we get our desired result. I would start here again to there, and I was surprised that it came to the golden zone or the golden ratio and basically took off. Okay, fine. It went that much, came back to it. Well, it didn't break below, it rejected it, carried on going. So I would have then entered perhaps when it broke this high. We started drawing from here to there. It pulled back to the golden zone for us, which is where we usually want to enter the trade anyway. It pulled back, to the golden zone. Yes, it broke below, but it didn't close below. It closed there. I would have waited for it to maybe get here. Even if you had entered here, that would have been fine. Why? That would have been fine as well if you had entered here. So here, at the close of this bullish candle, or the break of this candle, the break and close, which means it would have been a bit late, but I mean, sometimes better late than never. Why would I have entered here? Because we saw that this, there was a rejection of this golden zone with a long wick at the bottom, and the price, closed above it, showing that the bulls perhaps were taking control. It would have been a tight stop loss. Whenever you see a long wick, the way I would usually trade it is having a tight stop loss. So if I entered here, I would have my stop loss just below. I would have my stop loss just below. I would have my stop loss just below, which would have been a 36 pip, 35 pip stop loss, which is not much, knowing fully well that, you are after all looking at a harmonic pattern. Okay, fine. let's forget the harmonic pattern in case we didn't even see it. But we know if we entered here, we are targeting the next high, which is 70 something. That is like a 1 to 2 risk to reward, which is good. So what I am saying here, guys, is that a good way, one of the good ways for finding entries is to use the Fibonacci. One of the good ways for finding entries is to use the Fibonacci. And we see here, we have to wait for the break of the trend line. After all, looking at the harmonic pattern, it told us that the price was now due to go up, was most likely going to be going up. We are waiting for a confirmation to enter the trade only once it has broken above the trend line. Now, if we had entered the trade here, assuming the price did not, move to the downside and it gave us a price action to enter, maybe somewhere here, then obviously it would have been the case that, even if it went that far and it began to, retrace, we would have taken at least TP1, would have hit TP1, TP2 by now, depending on what you're using as your TP, before it came back to that point. You would have obviously since then moved your stop loss to break, there's no way you would have lost this, put it that way, if you had entered here, if this had not initially gone south, and it basically gave you a signal to enter. But then when it went up and came down like that, you would have then drawn a trend line. So what definitely to take away from tonight's meeting is that Fibonacci retracement tool usually is a good way to find an entry, and we should not forget the use of trend lines, because we saw that even in that trade, that trade on it was sometime last week. I can't remember what trade it was now. There was a trade last week. I mean, we see each time I draw the trend line, price tends to respect it. At least it gives you an idea of when to enter or to exit the trade. It gives you an idea of when to enter or exit the trade. Okay, I don't know if there are any questions.